And a very good afternoon to everybody. Hello and welcome to the Monday Horowitz & Company pop-up Q&A webinar. I'm Andrew Horowitz. I'm the president and founder of Horowitz & Company, and thank you again for so much for joining us each and every week. And I really appreciate that. I do want to go over a couple different things today. One of the things we're going to start out today is a quick poll. I thought we would go over what your thoughts are with regard to the market, and I'm going to push that right now to you. Of course, you have the opportunity during this discussion to ask any questions that you want that are on your mind regarding finance, investments, money, markets, taxes, whatever it is that you have on your mind. Well, we're going to give you that opportunity to ask it. And that's what this is all about, as we've been doing each and every Monday for the last several months. So I'm going to launch this poll right now. And the question is, are the market's valuations justified? Answer seems a bit high, seems about right, seems a bit low, or no idea, which may be the case. While we're doing that, let me just give you a couple of quick important disclosures that I want to mention. That the discussion today is not a recommendation to buy or sell any security. We're not going over any specifics of any particular investments. Past performance is no indication of future results, and this should be taken as educational only. It should not be looked at for legal or accounting or tax advice. So with that, let's look at some of the things that are going on this week, and I'll answer some of the questions as they come on. And then let's just stay here. Okay, we got this. All right. So here we are Monday. Used to be called Merger Monday. That's what we used to be called all the time. Now it seems to be, we've changed it. Now it's Vaccine Monday, at least over the last 2 weeks. Last week we came in, we talked about how markets jumped, went crazy when the Pfizer vaccine information was released on the efficacy of over 90%. And now today, not to be outdone, Moderna comes out with the results of their vaccine trial, 94.5% efficacy. And one of the things that was really interesting about the Moderna information was it doesn't have to be stored at negative 70 degrees, rather only negative 20 degrees, which is, it's still cold, but a significant differential. What I think is really interesting is that there is this this huge desire to kind of get this over with, as we know, of course. And even though we're seeing a ramp up of cases and hospitalizations and deaths all over the world, all over the country, it seems that markets have been able to look beyond that and ramp up. Not only recently, but the whole month of November is on this whole positive vaccine news. And even in the face of all the significant potential for lockdown, stay-at-home orders, intermittent shutdowns, caseloads increasing and all that, it seems to be that investors are pretty much saying, it's going to be over eventually. I might as well get on board. One of the things we are seeing is a rotation that started once. It started a little bit, I would say probably just before, but really took on where names in the area of tech and some of the growthier names that have stretched valuations started to sell off a bit, or at least not do as well as what we saw in financials, in industrials, in some of the leisure, hospitality areas, cruise lines, airlines. And that really was also on the heels of the election. The day after the election, when the presumptive winner, which hasn't been decided yet, of the election was Joe Biden, there was a change in the mood of the markets. And again, it was this big slope towards value, which has been out of favor for the last year or so. And with that, we are finding that there's a couple of reasons why that is the case. And we're going to get into that in 1 second. Let me end this polling right here. Pretty much everybody, I think there's a few people that haven't put in their poll answer about our markets justified. And the answer coming in as expected. I'm going to give it another second here as people are coming in. A pretty packed room today. Pretty packed webinar. I like it. Wow. Lots of people here. So let me end this polling and tell you what the answer is. So here's the results. And you'd probably expect this from what we're seeing recently. And that is our market valuations justified. 72% is thinking that the markets are a bit high. About 12% think that the markets are about right. 4% thinks a bit low. And 12% say they have no idea. So with that, I want to skip over. And this actually answers another question from somebody. I have a couple questions. Ask all your questions if you can in the Q&A, because the chat gets very busy if you start doing that, and I can't keep track of where the questions are. So if you don't mind, who is this? Ben. I'll answer the first one about the what do you have? The key reversal indicator. That's the question you have there. But the other question, if you can thank you. Thanks. All right, so let's get to this. This is kind of interesting. This is something that we look at on a regular basis, and it is an algorithm that we put together in order to take the pulse, the temperature of the markets, and let us understand where we are from a perspective of, is it overheated? Is it oversold? Are we in equilibrium? Where are we with the market? Now, This is not an absolute. What we do is really look at some key psychological indicators. We look at the directionality and the momentum of the markets. We look at the advanced decline lines, a variety of different statistical indicators, and come up with a final, we'll call it, point system for where we are. And right now, this was snapshot probably at about 11 o'clock this morning. The KRI was a +6. There's only been, I think, one time that I remember in the last many, many years that it was a +7. But +6 is pretty hot. And what this tells us, as you see on the right there, is that the overall market, as measured by this algorithm, is extremely overheated. And what this generally says is that a short-term and probably quick reversal of the trend is imminent as it's gotten too frothy. As we see that there is just too much bullishness in the markets right now. And what we usually find is that with a reading this high, maybe not when it's a +3 or 4, but when you get a +6, +5, maybe even +7, what happens is you see that there is the potential for a sell-off, but yet oftentimes you actually see at the same time the realization that that trend is probably solid. So that uptrend in this current circumstance is probably going to continue, but some of that froth needs to be worked off of the markets. And that's kind of where we are right now. Now, there have been times that we still continue to see upward movement, although it's a lot less intense. Over the last week or so, we saw some very significant moves, again, on the Moderna, on the Pfizer, the BioNTech vaccine announcements. But I want to show you something. I want to show you the history of this and what it looks like. So what I did here was I plotted all of the history and where the KRI indicator was in different time periods so you can take a look at this. And in particular, I'm going to kind of point out a few things. So when we come and we take a look, and this was in March, and we saw this area on the left-hand side of the chart where it was just getting overdone on the downside, oversold, till it finally started to resolve, and we saw that it moved from a -5, -6, all the way up back to the zero line, and that's when things started taking off. Now we started to get another overvaluation at the +6 level, and look what happened. I did a circle right there, and I'm showing you that we saw a pretty quick move to the downside. And then the resumption of that trend, a little choppy in between, till we got some footing, and that trend started to move higher again. Okay, now, with that, we saw also that there is the secondary area on this, where we see that there is a significant amount of movement on the upside that happened right in middle September. Another massive move to the upside, but not as much, but clusters where it was getting overheated, and then that drop. Okay, then we saw it get, again, resolved and move back up. We saw the same thing, a pop to the top, a +5 or so reading, and then the result was down for a while till the reading got, till the level got, I would say, burned off. That would be the best way to look at it. Here we are again with a +6 reading after a massive rally here. Now, that doesn't mean that we're going to see that there's going to be let's just say a big drop. We're not saying it's going to go just straight down like this. But at best, oftentimes what you see is at least a leveling off and that trend kind of start moving lower, even on these little ones right here. You see them kind of moving a little bit lower. Oftentimes, also, you need to get multiple clusters, as you've seen in this area. And let me kind of draw that for you and show you exactly what I'm talking about. In this area right here, you see you have multiple clusters. Usually when you don't, unless you get a blow off top, like it does look like we're getting close to now, you really need to see this inch higher and higher and higher until you get that move straight up. And then is when it rolls. Now, am I suggesting that this is it? It's over. It's done with. We have no longer have any upside? Absolutely not. Am I suggesting, though, that markets are getting frothy and that there is the potential for some of the weak hands, the holders that are in there just to say, oh, my God, I have FOMO. I need to get in right now. That just pushed everything up because they heard the word vaccine. They got all excited. They're thinking this is over. Meanwhile, we have to be honest. The U.S. situation is pretty dire. The amount of cases, the potential for what we're seeing, things like El Paso, Texas, and in New Jersey, and we're seeing in Chicago, seeing in California, seeing all around the country, there are spots that are all of a sudden starting to talk about or implement stay-at-home orders, selective or broad-based, depending where it is. That is going to have an impact. Now, at the same time, you say, well, okay, that's fine, but what about the fact that that's probably going to bring on more stimulus? I would say, yeah, that makes sense. I think that's going to be the case. I think that where we're going to have a significant problem is that there is still a logjam where we have, making an assumption here, that former Vice President Biden is going to become president, and we're going to have a House of Representatives that is Democratic, and we're going to have a Senate that is going to be slanting towards Republican. We'll have a lot of fighting going on, and things won't get smoothly done. For example, an infrastructure deal, a stimulus plan, etc. So there is stimulus that will offset some of that, and that's kind of, I think, what markets are trying to sniff out right now. Today there was a discussion by President-elect or former Vice President, whatever you want to call him, Biden, that, let's get something done. Let's do a HEROES Act, which is like a $2.2 trillion deal. So they're talking big numbers again, trying to get something implemented where the Republicans have been balking and trying to put in a skinny deal at the $500 billion level. So where we are right now is kind of at a crossroads. So there is this euphoria that's going on that, okay, we'll get a vaccine. However, it's still not going to be in play till the mid part or latter part of next year, of 2021, the vaccine. And even so, we may not even have enough to go around for more than 20 or 30 or 40, 50 million people. Now, some of that will be good if they are taken, if it does work, if it doesn't have any negative implications. But what we have is a situation where up until then, there's still going to be a lot of concern. And even though we have a 94.5% efficacy on the Moderna, that means 5% of the people still get it and could have adverse effects of the COVID virus. So there's still a lot that we have to get through before we claim victory on all of this. Now, I also mentioned that there is a, let's clear that. Let's clear all the stuff here. There has been a significant move towards the value side. The banks have been on fire. The regional banks have been incredible. The small caps have been really powering higher. Value versus growth has been in vogue. One of the reasons, this chart shows it. This one and the next one I'm going to show you. This chart is the Treasury yield curve. What it shows us is where we are currently, which is the blue line. And you can see that very easily when we kind of look right here. That blue line is moving higher from bottom left to top right. And what's important to recognize about that is this is a semi-normal yield curve where you have the lowest part of the curve towards the shortest duration 1 month T-bills, and you have it much higher, sloping higher to the longer. Look back to where we were at the beginning of this year. This is not a normal curve, pretty much flat I mean, we could say that during the period when we look at this, we were flat all the way from the 1 month to the 5 year and just moved up slightly above, and then it started moving. Right now, it's the 1 month pretty much to, let's call it the 2 year maybe. But after that, this all starts moving up very significantly. And this is what we call a normal yield curve. And when you have a normal yield curve, this is good for certain businesses. It's good for the banks. It's very good for the banks because the banks, what do? Well, the banks, they lend out the money over here and they pay you on your deposits over here. So that differential, when we look at it, when we go up into the level that's somewhere in here, is the spread. So if we take that back and look where we were before and we put the same numbers, where's that spread? Well, actually over here. The spread is maybe here to there. Look how different that line was. So the net interest margins on the banks, what they can profit, how they're making their bread and butter is much better right now. And that's a very good sign for the economy, for the banks. They'll lend out at those levels and they will actually have profits. And that's good. This chart shows us the 2 to 10 spread, pretty much the levels I was just showing you, but it shows us in a different manner. It takes basically the 10-year yield and it subtracts out the 2 year and it shows, okay, where's the differential? And you can see when we get into really negative territory where there's problems, where, for example, you're in here, in these levels where it's touching the zero line, there's no profitability for banks. No wonder where we had this level of movement down, banks were having a lot of problems. Now we're starting to see it move significantly. We went from a zero line in the last year or so, year and a half, up to about a point, we'll call 0.8 spread. That is where we see profitability. Now, it's not as profitable where there's a 3% spread like we saw in 2011. That's good numbers. These tops are really profitable areas for banks, all of these. This area right here, okay, we'll say give it a check mark only because it is off of that low where banks were having a very difficult time making money. So kind of a really interesting look and a view to understand better of what's happening with the bank stocks, why the value is outpacing, why the small caps, which have a very significant amount of regional banks inside that index, is doing so well. So you got this big beneficiary of the banks, Biden, which has been very good for small caps, financials. That's been good. The idea that, we have a vaccine, the leisure stocks will do better. And some of the other things that are happening is we have the continuation of the weakening of the U.S. dollar. There was an article out today that talks about how the expectation is that the U.S. dollar will not only remain weak, which, by the way, the U.S. dollar is down about 11% from the March high to where we are now. Expectations are for the U.S. dollar to sink another 20%. Now, if you are thinking that what is that investment that would be good for a U.S. dollar being weaker, you'd have to think generally commodities, but definitely lean on silver and gold. We made a big move over the last few weeks for many of our portfolios. We're still going through some of those and kind of rebalancing and looking at where we want to be from the perspective of what happens when we have a weak dollar, maybe a weak economy, which is the reason why we're going to have a weak dollar compared to the rest of the world due to the fact of our out of control wildfire of this coronavirus and no real federal plan for any of this at this point. It seems to just let it just burn itself out, I guess. And with that, what we have is a situation where there is a significant amount of differential between, for example, some parts of Asia, even to Europe to a degree, but those countries may actually recover a lot faster than we will, and therefore their currencies will strengthen. So that's why we kind of leaned in on some gold and silver as a precious metal, as we believe the dollar will continue to move lower. So just something to think about there. Let's clear all this. All right. Now, what else do we have here? Major issues for the market. Let me just kind of rattle these off, what we're looking at right now. Some of the things that are important. And I'm going to get to your questions. Like I said, put your questions in the Q&A panel, whatever they have, whatever they may be on any subject at all. We'll do our best to answer them. So the major issues for the markets right now, well, the yield curve, which we just talked about, I think that's very, very positive for certain parts of the market, not so good for others. We have the Fed, who's in play, trying to keep rates down, losing the battle right now. We have the U.S. dollar potentially weakening. Clearly, the elections, we still don't have an absolute answer. We're still up in the air. No transition of power, no concession. Not going to be a concession until the fat lady sings. Until that electoral college votes, the recounts are done, all the trials and the legal issues are put away with, and we'll go from there. Not the best thing for our country, but yet, a lot of question about fraud and questionable voting tactics. The vaccine, the path of the virus, and of course, stimulus. So those 5 or 6 things are really what is now. You notice I didn't say economics. I didn't say earnings. I didn't say either of those 2 things. What we really have is a market that is really all about right now the stimulus, the Fed, yield curve. But again, economics will follow in. Nobody's really looking at those, how good or bad the numbers are, aside from when they come out immediately, and then they kind of go from there. Let me mention a couple of things, and then we'll get to some of the questions. The Disciplined Investor podcast, gaining popularity. Thank you so much for telling your friends, family, and being a part of it each and every week. Try to bring on some new and exciting discussions, so make sure to listen to that. If you do want to get in touch with us, our numbers are on the screen. Emails on there, the website, thedisciplinedinvestor.com. Email is info@horowitzco.com. If you want us to take a look at your portfolio, if you're not sure what to do, you're not exactly feeling it, we talked about the 1 foot in, 1 foot out. We talk about that process of doing a multi-factor dollar cost averaging program. That's something I think if you're on the fence, don't know what to do, and you're like, oh, I keep on losing out or not making money, or I want to be there. I know I should be there, but I can't do it. I'm nervous. Well, that's something that you should really consider. We'll help you along with that. Let me answer one question. This came from Ben. He said that I posted on Twitter today that the KRI is extremely overheated, but it's about a 2 to 3 on the private website. That updates, I think, once or twice a day. So it may update by tomorrow, maybe a little bit lagged on that website because it's a whole program that sends it out, and I'm not sure why it doesn't. But that is just informational. I'll talk about it when it comes up. So it should be there probably by tomorrow. I would think that it's going to update because we don't update it throughout the day all the time. It updates I believe it's an end of day update for that site. So hopefully that answers that question. All right, let me take a swig of my water here and answer some of these questions. The first one's from Aaron. And Aaron asks, he says, the Ant IPO was delayed by the Chinese government because the comments which were seen as disruptive by Jack Ma. With the recent increase in party line enforcement by President Xi, how do you view new investments in China-based companies until new U.S. administration begins its policy declarations? Well, I don't know if I necessarily would think that I'm going to blend in the new administration's tactics against or with or for China on this one. I think that Jack Ma kind of forgot who he was and where he is. He is the richest or one of the richest people in Asia, clearly in China. And, he's with the Alibaba. And I think his comments about the financial system and the irregularities and problems and what he's trying to solve with Ant Financial, you just don't do that kind of stuff in China. I mean, how stupid. A lot of this is government backed. And in China, if I was him, I'd just shut my mouth and let it just happen. But yet he decided that he is going to pretty much, scold the Chinese government. And this is a guy who's allowed to speak and listen to, and he embarrassed them. And that's just, I don't know. Maybe it was the right thing to do. Maybe he was correct. Maybe it was even, something that would be very helpful long term. But it's not something you do. It's just stupid. It's just stupid. So I think that from the perspective of finance, now, again, he may have been right of what he was saying and all that, which he is. I mean, there is a problem with the micro loans and all that goes on inside the financial system and the zombie companies inside there and the loans and loan losses that are going on. But again, he may have been right, but probably not something you want to talk about if you are going to want to get this deal done, especially he did it just days before the IPO. All right, James asks, I felt like I had to hold myself back from panic buying because these last few sessions, and I did buy small cap value, energy, and foreign index. Is the rotation trade here for real this time? How do you approach the feeling of FOMO? So there's two questions there, and I think that's a really good question there. I think what is the problem with the FOMO trade is kind of like when you have an absolute indication and you're studying let's say the financials and the fundamentals, and you feel, hey, you know what? There is no way that I can invest in this company at these valuations, but somehow you bring yourself to do it anyway, into a point that you really just say, you know, the hell with it. I can't take it anymore. I'm putting money to work. Now, you're talking about energy. You're talking about some foreign. I'm not sure if it was emerging, if it was, otherwise. And you're talking about small cap value. Small cap value has been so obliterated over the last couple of years comparatively to the valuations and to the small cap growth and to the large cap, mid cap indices in total. So I don't necessarily think that's a problem. Energy, the same thing, although energy I have a different discussion on. I think that, you have to believe that there is going to be a reversion trade eventually. And I think only time will tell, but I think there is going to be, and there has been the process of and the start to this reversion trade. Just not everybody can keep on throwing money at the Zoom medias, at Google, at Peloton, at Wayfair, at all these companies, and the valuations are just obnoxious to a point that, that's where the problem is. Listen, where things are right or wrong. I don't necessarily think that these were FOMO trades. Now, they may have been short-term FOMO trades for you. You're like, okay, I want to get in. They're moving. I better get done. Okay, I understand how that goes. You just got to look at the fundamentals. You got to look at the charts, and you got to stick to your program and say, you know what? One, and ask yourself, do I want to be in? Not for today, not for tomorrow, but for the long haul. And if you do, then you got to find and pick your areas that you want to invest in. You can't get scared out. For example, we had a stock that we like. It's a, we'll call it a charging station for EVs, for electric vehicles. And, we're starting to make some money on it. Comes out with earnings, drops down. It was up 25% today because the realization is that, this could be something really good for the future. Now, was it going to be maybe down 12% tomorrow? But you know what? You have to look past the interim noise on some of these things, in particular, some of the things that you're investing in. So getting past FOMO is all about what's not happening today or tomorrow, but what's happening a year from now. Are you an investor or a trader? If you're a trader, you'll never have FOMO because you're in and out so fast it doesn't even have an effect. If you're an investor, you could have FOMO, but then revisit what is your plan, what's your goals, what's your time horizon, where you want to be, and then figure out, is the investment for the long haul? And if it is, kind of realize that whether you get in today or tomorrow or next week, a little bit higher, a little bit lower is not really the issue. The other thing about FOMO that you could do, and one of the things that we have done and how we implement things, is we slowly but surely invest. For people that have that concern, right? I don't want to be in, but I think I need to be in. Well, you don't have to be in all the way. You can kind of wade in a little bit at a time, which it looks like it's what you're doing. So hopefully that helps, James. Ben asks, you could address this if you want or not, since it's specific, but what are your thoughts on the vaccine, the Arcticus vaccine that should be one dose and doesn't need to be kept frozen, and has an effective of 77 out of 78 people. The last person was admitted 2 weeks late, so still has 2 weeks to show. You know what? Ben, honestly, I don't track that as much, but obviously the big issues right now with the vaccine is what is the temperature it needs to be kept at, because the distribution of a vaccine at negative 70 is not the easiest thing in the world. Negative 20 is not easy either. There is not a lot of facilities that can have that or meet that requirement. But if you can have an efficacy of that's close to 99% and does in fact keep a significant amount of antibodies, and that's that's all of this stuff. All of this is probably going to make its way through fast tracking, and there's going to be a lot of companies, and unfortunately, it's going to create a lot more confusion. You're going to go for a vaccine, you're going to be like, well, which vaccine do you want? Well, I don't know. Or you're going to go for a vaccine, and they're going to say, I'm going to give you a vaccine. You're going to say, well, which one am I getting? Like, well, we only do this one. Well, then you got to find somewhere else to go, maybe, if you don't want that one or the other one. So it's this whole process is very new. It's not just one company has it. It's not just one repository. So unfortunately, I think that all these things have a lot of promise. We still have a long time to wait. Mac asks, my question concerns the fixed income portion of my portfolio. I've had quite a few individual higher rated 2 and 5-year corporate bonds mature in the past 6 months, and I'm obviously having a hard time reinvesting the proceeds into similar securities in the same yields. Yeah. I'm not looking for a home run, but would like to achieve a 3 to 4% annual income stream from these investment bucket. I'd be very interested in your opinion on reinvestment in mid-duration 5 to 7, lower credit corporates, BBB and above, versus preferred stocks versus dividend-paying equities and REITs as a way of achieving this goal. So some of the things you hit on there, Mac, you hit on the REITs, which I think is really interesting, but be careful not to get levered REITs REITs that are too levered, I should say. Some leverage is usually part of the thing. The investment, depending on where you go. I would stay away from commercials. I mean, heavy commercials, and be careful about that. You can get a good yield on that. The problem is that yields are really tough right now. It's going to take a while for the markets to flush through this low yield environment and then try to reset itself into a place where you can get those kinds of yields. Now, I'm not a big fan right now of some of the lower rated bonds. I think a lot of them are being held up by the Fed, and that will continue for some time. But when it doesn't, I think you're going to see a pretty big cut in the potential for your principal value, which it doesn't really matter that much if you hold it until maturity, kind of ride it out if it's a good company. But a lot of the companies on the lower end of the grade, often right now, calling them zombies, they don't have the revenue to pay off all of their debt service. That's a problem. So you got to pretty much dig. So I think that preferreds are interesting, but yet, again, things get hit. They're illiquid, could have a problem there. I would think that, if you would like to look for some low beta equities with decent yields, especially in some of the industrial space, some of the value space, I think that you may have a better opportunity there, especially as people start sniffing out that the value trade may be coming back. So hard discussion to individually replace right now. I think you need to start staying on the shorter end of the curve, under, like you said, mid-duration 5-7, but under that, and under the that maturity under, we'll call it about the same, maybe 10 years, maybe. I don't like the lower credit environment right now. Like I said, just repeating this, dividend-paying equities, I do like to a bit. Again, I also, would look at some municipals right now. There are some municipals that may be in better shape, especially those that are insured. Get some decent yield on those. Ben asks, with accounts where you can't purchase puts as a hedge in oversold conditions like we have now, would you recommend things like SPXU over the short term, even though say these are designed for traders only? That would be for a hedge, not large. Yeah, so whether it's XPSU or SH or whatever the particular name is of the instrument, holding it for a week or two for the leverage ones at the most, not as much of a problem as some of the levered, triple levered, double levered, commodity style ETFs. Those are just bad on tracking. They especially like oil or any of those. It's just They don't work so well. But when you come to equities, it's a little bit different. They track pretty well for short periods of time. And even if you have a little bit of a bleed on that, not the biggest of deals. You're not going to be like a big margin over a week. But yes, I would think that that would be something that you could do and build into it. But again, don't get stuck on it because that happens sometimes. But again, some of these do track pretty well. And simply what you should do is just take the price change on a daily basis, chart it out over time on a chart, take the same symbol as the underlying. So SPXU is the S&P. So take the S&P, look at that, multiply by 3, for example, and see if it tracks similarly, which you'll see over time it will. Starts to get a little bit separate over time, though. Next one. Says, I listened to the latest TDI podcast yesterday. I think you recommended taking a closer look at corporate bonds, but didn't get your position on investing in corporate bonds or not. Were you implying that there's better investment opportunity in stocks? Can you please elaborate? I think you need to be careful on the corporate bond side right now because incredible amounts of debt have been added to the system. Yes, at a lower rate than have been, but companies are flush with debt. Watch the low, as I was mentioning a little while ago when, who asked that question? That was Mac? I think it was Mac. So Mac asked this question, and the point is that lower grade is really a concern. I don't think that's something you want to do, especially if we have an increasing interest rate environment. The Fed lays off a little bit. We have a market or an economy that's kind of healing and doing a bit better, maybe not great. And then on top of it, you have a situation where there is the potential for the markets kind of change dynamic. Now, on a risk on, if everything just is hunky dory, it doesn't matter as much. But again, a lot of these corporates right now are having a problem or are going to have a problem if the Fed isn't there to step in to replace their debt in the future, because the Fed is just buying anything regardless, not looking at fundamentals for the most part. Now, there's certain limitations of what they can do. I agree with that. But yet, I would just be very careful on the corporate side of things. I think that we are in for a problem if we see a skew event where yields start coming up substantially, which is not what the Fed wants to do, which is not what the government wants to do. But yet at the same time, we still keep on layering on debt and more debt and more debt. Corporate, sovereign, you know what? It's going to break eventually. So we just want to be careful on the duration. We want to be careful on the quality. We want to be careful on the type on that. And I think the corporate it's fine. It's okay. I don't have any problem having short duration corporate, but yet at the same time, higher, mid to high quality from there. Aaron says, I appreciate your thoughts on Jack Ma's chutzpah, but does it color your thoughts on starting an investment in, for example, Alibaba? So I think Alibaba is going to get smacked for a while potentially, but still Alibaba is a great company. I think that it's been hit pretty hard on a comparable basis. And probably a lot of that had to do with the Ant Financial recently. You got to wonder, though, if something's going to happen on. Listen, Jack at least didn't get taken away with a black pullover into a black SUV into a site somewhere and wasn't seen for a number of days, like you've seen before in different areas around the world. He didn't get that treatment, but he got the treatment of everything else and of the financial pain of what he did. So I think that I think the big issue right now is that Alibaba could be good. I'm not really giving you advice on this one investment. One of the things that we saw over the weekend was the trade deal, the Pacific trade deal, ex-US, that was created. And that is something, we're going to talk about this tomorrow night, by the way, on DH Unplugged, 9:00 live, dhunplugged.com. I don't think that it's a bad investment, and I would tend to think that if Biden is the president, that there will be a little bit more, let me restate that, less agitation with China. So, I like the company. I don't have any problem with it. I just think it's going to take some time to flush through the system and get some clearing here. We have one more question left. I'm going to answer it now. If there's no other questions, we're going to end it after this. But if you have some questions, they'll probably flow in. We'll answer those. Next question. Thanks for raising our awareness on rebalancing portfolios after the election. I see China has signed a trade deals. Which sector will be beneficial the most? Well, I mean, what you're seeing is that the trade deal was not with the U.S. though. The trade deal was with Asian, Pacific Asian, Pac Asia, if you will, and so it's not really necessarily here. It could hurt us to a degree. China's really trying to. They've been working on this for a while. This trade deal, but it could create a quote unquote most favored nation kind of thing with outside of U.S. We were specifically left out. Not that we would have probably signed on anyway, but now you have a block of much more power over there. Remember something? There was a talk for many, many years about replacing the U.S. dollar as the world's reserve currency. So I'm not sure if that's going to be the case moving forward. But yet there probably is going to be a desire for those countries to work together a little bit stronger. What sectors will it be benefit? I don't know, but it would probably help China in a good way, like what happened when the EU was formed. A little bit different situation, but when the EU, it really helped Germany. The anchor store, if you will, is really what gets a lot of the pull, and China is the anchor in that agreement. So hopefully that helps. Hey, thanks for joining me. We'll have this replay up tomorrow. Thank you for all that you do, bringing your questions each and every week. Listen, if you're not a client already, maybe it's time to think about it. We're here to help. We're here to manage your money. We're here to do what we can to get you to where you need to be. Thank you so much. Make sure to contact us. We're friendly. We do what we can for you. And I will see you again next week.